The Dutch East India Company used hundreds of ships in the 1600s to conduct international trade in silks, gold, porcelain, spices, and other goods. But it wasn't inexpensive to manage such a large company. The corporation turned to private citizens, people who could invest money to support the journey in exchange for a percentage of the ship's profits to finance their pricey travels. By engaging in this strategy, the business was able to fund more bigger excursions, boosting earnings for both themselves and their astute investors. The Dutch East India Company unwittingly created the first stock market by selling these shares in coffee shops and shipping ports all over the continent. Since then, firms have been raising money from eager investors to support a variety of industries. Today, the stock market offers educational opportunities, jobs, even entire television networks devoted to comprehending it. But compared to its earlier iteration, the modern stock market is far more complicated. So how do businesses and investors currently use the market? Consider a brand new coffee business that decides to enter the market. The business will first market itself to major investors. If they believe the business to be a good one, they get first dibs on investments and sponsor the EPO of the business. This places the business on the formal public market, where any corporation or person who thinks the venture could be profitable may purchase a stake. By purchasing stock, investors become a small stakeholder in the company. Their contribution aids in the business's expansion, and as it prospers, additional investors may start to recognize its potential and purchase stock. As the demand for such stocks rises, so does their price, raising the barrier to entry for potential buyers and boosting the value of stockholders' existing holdings in the company. By demonstrating how many individuals are prepared to invest in their idea, the company's increasing interest not only helps fund new initiatives, but also increases the value of the company's stock as a whole. The opposite can also occur if, for any reason, a business starts to appear less profitable. Investors who believe their stock value is going down will sell their shares in an effort to profit before the company loses any more value. As shares are sold and the stock's demand declines, the worth of the company as a whole decreases along with the stock price. This might result in significant losses for investors unless the company starts to appear profitable once more. Numerous factors affect the supply and demand pendulum. Market dynamics, such as altering labor costs, shifting material prices, and changes in production technology, all have an inescapable impact on businesses. Investors may be concerned about shifts in management, negative press, or more significant things like new legislation and trade policies. Of course, many investors are also just willing to sell attractive assets in order to follow their own interests. Due to the daily market noise caused by all of these factors, businesses may appear to be more or less successful. Additionally, in the stock market, losing investors as a result of a perceived value loss might result in actual value loss. Market confidence has the ability to start anything from financial crises to economic booms. The majority of experts advocate dependable long-term investing over trying to make quick money because of this hard-to-track element. In spite of this, professionals are continuously developing tools to improve their chances of success in this wildly unpredictable environment. But only the wealthy and powerful have access to the stock market. Since the advent of the internet, small investors can purchase stocks in many of the same methods as institutional investors. Additionally, when more people gain knowledge about this intricate system, they can also trade stocks. They support the companies they respect and work toward their financial objectives. Investing is the initial step.